The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Hello and welcome to Squawk Box. Here are your headlines today. UBS beats on the top and bottom line, posting a net profit of $1.8 billion as the Swiss lender says its integration of Credit Suisse is on track. We'll be hearing from the CEO, Sergio Amotti, at 8 o'clock CET. Spanish lender Banco Sabadell rejects rival BBVA's €12 billion takeover bid, saying the offer significantly undervalues the bank and its growth prospects.
Elsewhere, the Chinese President Xi Jinping gets the red carpet treatment in Paris, but sticks to a familiar diplomatic line in talks with Presidents Macron and von der Leyen.
共同防止新冷战或者
China and France must maintain independence, jointly prevent a new Cold War or confrontation between camps, insist on mutual understanding, and jointly promote harmonious coexistence in a colourful world.
Plus, Hamas agreeing to a ceasefire proposal in Gaza, but Israel says it falls short of its demands as the IDF strikes targets in eastern Rafah.
A big day for bank numbers already. UBS crossing the tape, and we're waiting for UniCredit as well today. Now, just to recap on the numbers that UBS has posted minutes ago, it has blown past estimates in its first quarter results, with earnings per share coming in at 52 cents, more than double expectations, and reported net profit coming in at $1.8 billion. I looked through some of the numbers today. The company's talking about the progress they've made in the integration of Credit Suisse, calling it substantial progress, achieving $5 billion of exit rate gross cost savings compared with 2022, combined cost base of Credit Suisse and UBS out of the $13 billion of exit rate cost savings that they aim to achieve by 2026. So 5 out of the 13, just to summarize that, in terms of cost savings. So that is a positive in terms of the progress. Those cost savings, though, are likely to decrease from the quarter rate to around $1 billion. So those numbers that they're saying on the cost savings point of view, I think that's key. I
do. But I wonder, everybody expected good numbers from UBS and from Sergio Amotti and the integration of Credit Suisse. It's almost a year now since that. But well, it's over a year since they announced it, but of course, almost a year. It'll be soon, on the end of May, then they're expecting the full integration. But is this now a story about the performance of the company itself? Of course, but is it also now a story about what the regulators, what the Swiss government want to do to rein in this company? Because it seemed to me that the shares were on a wonderfully gentle upward trajectory from the lows from when the deal was announced over a year ago. They only started coming off moderately aggressively and down 4.6% year to date, but a little bit more off their highs since the Swiss politicians and regulators and parliamentarians started getting in on the act, worrying about the size of UBS.
Yeah, well, I did speak to the Swiss finance minister recently.
Yes, she did. This is a woman who the bankers feel wasn't quite in touch of the situation when Credit Suisse was going through its travails.
So she wants more ammunition just in case. I think there is a view out there that this framework wasn't right in terms of tackling Credit Suisse at the time, so beefed up armour is what the regulators are calling for. So that'll be interesting. Just a quick line here that Credit Suisse also, they further repaid the funding drawn down under that emergency liquidity assistance facility. So again, cutting some of the shackles from that assistance.
Someone who doesn't have to worry about this, André Alchel, the shares in UniCredit are up 42% this year. That's quite extraordinary. By the way, we are speaking to Sergio Amotti, of course, a little bit later on. UniCredit net income guidance full year 2024 increased to over 8.5 billion euros, and guidance on the distribution for 2024 full year increased to in line with 2023. Let me just take a look at the numbers. This looks like a huge beat on the first quarter net profit, albeit compared with company provided consensus. The consensus was 2.13 billion euros. They've come in at 2.56 billion. So a big beat on that number. Again, I always have a pinch of salt when they say compared with average company provided consensus. But again, total revenue, big beat there, 6.37 billion euros versus 5.94. Net interest, 3.58 billion, a slimmer beat compared with the expected 3.51. Net commissions in the first quarter, again a solid beat here, 2.1 billion euros versus the company provided consensus of 1.92 billion as well. CET1 ratio, no issues there on the regulatory capital, it seems, 16.23%. Something you're interested in as well, Karen, I know, because we're looking for signs of stress on both sides of the Atlantic with higher interest rates, write-downs, underwhelming. Well, actually, overwhelming if you're looking for a low figure, underwhelming if you're looking to see cracks in the system. 103 million euros versus 178 million in the company-provided consensus. So once again, very interesting to see that actually the delinquencies, the non-performing loans, the impairments remain stunningly low at the best European banks.
Is there a tipping point for the higher for longer story where you start to see that net interest income supported, but you do see the write-downs ramp up? And I think we're not at that tipping point just yet. Obviously, the numbers coming through better than expected. And you're right, I was looking at that write-down line about 3 times. And that is good news that you're not seeing any sign of strain coming through in that line just yet. Is it the sort of business that they're writing? Is it the macro environment? I mean, that's the broader question. I think there's been a view that the Italian banking system is in a much better position than it's been in the past. There's been a lot of the bad debts that have been put into one bundle and cleaned up and put elsewhere. So does it come into this cycle in a much stronger position? And is that supportive for the likes of UniCredit?
Yes, I think the best of the best seem to be doing rather well regardless of the underlying conditions, don't they? Gross non-performing exposure ratio at the end of March was 2.7%. I will just do a couple more figures. I think they're important. Return on tangible equity seen above 15% in 2025, 2026. The group sees strong EPS, DPS growth in 2025, 2026. And we will be speaking to the CEO of UniCredit at 7:30 Central European Time. Well, in the meantime, we've seen numbers also coming out from DHL. The first quarter basic earnings per share have come in at 0.63 euros per share. What else can I tell you? The 2024 forecast has been confirmed. Group revenue down 3.2% year on year, but has come in at 20.3 billion euros. A group EBIT at 1.3 billion euros, down 19.8% year on year. Well, with that in mind, let's get a gauge on what's going on both at DHL and in broader trade and logistics. Always welcoming to the show is Tobias Meyer. Tobias is the CEO of DHL Group. Very good to see you, sir. Thank you very much indeed for joining us. Well, why don't you just run us through what you think of the highlights and the difficult challenges at the moment?
Yeah, good morning. Great to be with you. So we continue to see a bit of the economic cycle unfolding. We have an unusually long trough in global trade volumes. This has been going on for quite a while now, that we basically see sluggish global trade. The geographical pattern is shifting a little bit. So we saw some more activity out of Asia and air and ocean freight. But on the other hand, our European business, inter-European trade, continues to be really very weak. And that's obviously a very important market for us. That is across modes that Europe has had a very slow start in 2024.
That's really interesting. Do you see any signs of recovery in Europe? There you go.
Look, we're following other statistics as well. The Purchasing Manager Index has been up in recent weeks, and our e-commerce business, for instance, in Europe, but also across the globe, is actually doing well. So there are pockets of growth where we participate, but the general B2B environment, especially in Europe, continues to be weak.
Can I ask you what you're seeing on freight volumes then and pricing? Because last year you were talking about a year of normalization. What's coming through this year?
So we obviously had this humongous spike during the COVID period, which was a bit of a once-in-a-lifetime event with extremely high rates, a shortage of freight capacity. You remember the issues in the Suez Canal that led to an additional spike. In the ocean freight environment, the world is a different world. Not that we wouldn't have ongoing disruptions. We do have that, the Red Sea being one example of that. But the demand-supply balance has shifted quite a bit with significant inflow of tonnage over the last months. So in ocean, the supply-demand balance is quite in favor of shippers. that doesn't mean that there wouldn't be interim spikes when there's a shortage of equipment, for instance. So this is an environment in ocean. In air, we see continued demand, especially from big e-commerce platforms out of Asia. So that's absorbing a lot of capacity and stabilizing the market. But the general B2B trade, again, continues to be weak.
I can see air freight volumes rising by 5.1% in the first quarter. Can you just get into the weeds on China at this stage? Because we've been getting a mixed bag of numbers, some of it suggesting a slight pickup out of the Chinese economy, others still suggesting ongoing problems. What are you witnessing in terms of strength out of that Chinese market?
So there's definitely a lot of export pressure in China. We do see that. The domestic market for some manufacturers seems to still be soft, so they are looking for opportunities overseas to export their goods. On the other hand, you have to be careful with the year-on-year comparison. Q1 2023 was quite weak, also when it comes to ex-China trade and air freight volumes. So yes, it looks good in some ways on the year-to-year comparison, but in absolute figures, also if you compare it over several years, it's rather a moderate outcome.
We've just been looking at interest rates with the reporting of UniCredit and UBS numbers as well. But we also noted in the case of UniCredit that very low delinquencies, low impairments, considering where many people expect them to be at this stage as well. Which says to Karen and I on the surface that the pressure for lower interest rates in Europe and elsewhere isn't actually as tantamount as some of the pundits may say as well. Do you think a change in interest rate in scenario globally, in the States, in Europe and elsewhere, do you think it will make any difference to the trade prospects at the moment, or actually is that not where the pressure is coming from?
Well, we do think that it is a very important indicator for the health of the overall economy. Whether it has a direct impact is hard for us to judge, right? What is more the development of the overall economic cycle that central banks adjust to? What is the direct impact of the interest rates, particularly on capital equipment? It could obviously have a significant impact. It should influence the decision-making of investors. But for us, hard to see what is really the overall development of the economic cycle that central bank adjusts to and what is the outcome of the interest change in itself.
So, Tobias, that's interesting. We've talked about Asia, you and Karen. We've talked about Europe as well. We've talked about interest rates. We've talked about the lack of clarity and the relative weakness of PMIs. What can you do as a group to mitigate all of these bubbling concerns across the board?
So we do continue to invest, and this is really good for us in this economic cycle. We have the house in order as a group. We don't have major construction sites through big M&As or restructurings. So we are still on a very good earnings level if you look at our long-term trajectory. So we continue to make careful investments in capacity in e-commerce. For instance, you see that depreciation in our e-commerce division is quite up a bit. So that is an outcome of creating capacity for our customers, for instance, in Europe. But also in our express business, we continue to invest in quality and we continue to invest in decarbonizing our business. So we really want to use also the trough part of the cycle to be ready for the upturn and to improve the quality for our customers.
Tobias, I'm just curious about the Americas part of the numbers today, the 3.2% that you see in terms of the Americas revenue on e-commerce. This is fascinating because we've been hearing overnight from Jane Fraser over at Citi that there's a two-speed consumer behaviour pattern that's been really emerging more this year. We know that some of the companies have been trying to manage their inventories very carefully. What is this 3.2% handle telling you about the state of the US economy from the consumer point of view? Tobias, I think the line is a little bit stuck, so let me just try that again. Can you hear me? Can I just check in with you? I think his line must be frozen.
I think it looks frozen as well.
It does look frozen, yeah. But I think the point I was trying to get from Tobias was that you're seeing very slim growth out of the Americas business on e-commerce. You're seeing much higher level out of Europe, actually, and obviously the bar here can be quite interesting in terms of comparables. So it might be a bounce off a low base when it comes to the Europe revenue. Asia, a little bit in the middle when it comes to the Europe, Asia, and Americas business.
But look, some of these numbers are, obviously they're getting their own house in order. They've got their own house in order as well. We're talking about what they can do to mitigate as well. But some of these numbers they're pretty bad globally. Ocean freight and global forwarding revenue down 25% year on year. Air freight down 16%. The blended figure down around about 19.8% as well. And you just look across the board, and there are some really tough figures out there as well across their key metrics. And I didn't get the impression, despite, this is the man who has taken a lot of measures in order to get their house in order regardless of what's going on. I didn't get the impression they seemed that optimistic about Europe. And I've looked at some of the German freight figures as well. Again, slightly troublesome. Asia, China, where's this big recovery? Look at this headline out of the FT today. How about this? We've just spoken to one of the biggest logistics companies in the world. Look at this headline from the FT today. Global trade growth set to more than double this year. The OECD, the IMF and WTO all predict sharp rebound in global flows of products this year after 2023 slump. So that's where I was angling with my questioning. I was looking to see if one of the actual practitioners of global trade, one of the key global trade practitioners, is seeing what those august bodies are saying. And I didn't get any impression whatsoever from Tobias Mayer there, one of the most important people in global logistics, that those headlines are accurate.
Yeah. I think we've also got shifting sands. I mean, the tone, very interesting out of the beginning about the e-commerce coming out of China. And I think we're alluding to a Shein and Temu in terms of some of those cheap products getting onto aircraft and coming over to Western markets. But I wanted to see the other side of the lens, which is what's coming out of the United States market in terms of appetite from the consumer, whether it's just about these low-end products.
You're talking about products for the millennials and Generation Z that don't actually like fast fashion, that care really more about their goods, that only want to buy less goods but more quality as well. Utter nonsense.
Cheap products at this point in the cycle.
Cheap products, as cheap as they can get them. And who cares how they're made, eh? Or the impact for the environment. That was Tobias Mayer anyway. If you can hear us still at DHL Group, thank you very much indeed. It was a very interesting interview. In the meantime, talking of interesting interviews, Arabile, what's coming up?
Well, Steve, Goldman Sachs' CEO David Solomon says that the Fed could hold rates steady for the rest of the year, ultimately bringing up what you've heard from quite a few people. We'll bring you those comments after the break. Plus, Banco Sabadell rejects a blockbuster takeover bid from rival lender BBVA. We'll break down the latest on that one. And as earnings season continues, we'll discuss the latest results and out of UBS. The CEO, Sergio Imotti, joins us. Don't miss that interview. It's at 8 a.m. CET. Stay tuned to Squawk Box Europe.
Listen to CNBC's Beyond the Valley, the podcast that explores the biggest tech news from across the globe. Join me, Arjun Karpal.
And me, Tom Chitty, every week as we bring you insights into the top stories, unpack the latest trends, and find out where the industry is headed.
Now available on Spotify, Apple Music, and Google Podcasts.
Welcome back. So the old adage is sell in May and go away. I know we're only 4 days into the trading month then, but so far there's no signs of that. There's a significant more than 1% uptick, both for the NASDAQ and the S&P 500, pretty much the same as you saw then just out of Friday's trade. Just to give you a note, from the record highs that were hit last month, the S&P 500 fell 5.5% then to below 5,000 points. We're now at 5,180 points then, and that is just 1% shy of the same record highs that we had hit just around a month ago. So is that pullback that we saw, that 5.5%, is that completely done? Is that what the market feels was enough of a breather and would continue the bull run? We'll certainly see, of course, what the market thinks. Of course, interest rates being quite important to this, or inflation expectations as well throughout the rest of the year. So too, the earnings potential of companies and what that pretty much looks like in this Q1 earnings season. It was the third straight positive session then as well for the S&P 500 yesterday then, with only real estate stocks in decline then yesterday. Speaking of real estate, of course, the interest rates, question marks, will certainly be one to look out for. Treasuries did rally on Friday, That, however, has seen them remain fairly steady then overnight, and pretty much 4.47 is where you're seeing the US 10-year Treasury note. Then interest rate markets are pricing in at least one interest rate cut, that happening pretty much in November. But could there be more is certainly the question mark that the market is asking itself right now. Of course, we are looking towards Disney, which is on deck tomorrow. And today, in terms of data, March consumer credit numbers out of the United States, Steve.
Yeah, and we had the SLOOS yesterday, which been reading a lot of copy about it. I mean, the senior loan officers' opinion survey, and things are tight-ish was the answer. Tight-ish, demand's okay, but not great in some areas, such as commercial and industrial. You and I talk about a lot of issues every day, and we try and make it a bit different. Now, we can't always succeed, and sometimes say, oh, look at Steve and Karen, they're talking about the same stuff, they're taking the same arguments again, they're having the same argument,
Do you think anyone actually does that voice?
It's the voice I used to do for my son, actually, when he was a teenager. But it's the voice I have for a distracted viewer.
I have no idea where you're going with this.
Well, no, you don't. But you do, actually, because you know me very well. The point is, how many times can Fed officials say the same thing? And you know, I went through that list yesterday, about 10 of them speaking this week. Well, a couple of them already spoken. So let's see if they manage to say the same thing in a different way. Including from the Richmond Fed president, Thomas Barkin, who says the central... here we go. Have you said it in the new way? This is the challenge for them all. The central bank can afford to wait for inflation to cool down before cutting interest rates. He added that recent data whiplash only strengthens the case for a cautious, deliberate approach. Was that new, or was that pretty much?
Very similar to what we've
So
heard.
do we give him the Joaquin Phoenix thumb up or thumb down?
Approach.
I say Joaquin when he was in The Gladiator, of course. Thumb down?
Thumbs
Same.
up.
Thumbs up? You think it was different?
Up. Slightly.
All right, well, okay. What about the New York Fed President, John Williams, who refused to say when the first rate cut can come, adding that current monetary policy was in a, quote, very good place. Thumbs up or thumbs down?
I'm giving you a thumbs down for
thumbs down for that one. It's
clarity.
similar. We should do this. Actually, there should be a new segment. Every time a policymaker in the States says anything, we're going to give them the Joaquin Phoenix Gladiator thumbs up, thumbs down, yeah? I take it you've seen that film, because you haven't seen many.
Yes.
Okay, thank God. Goldman Sachs CEO David Solomon told our US colleagues, here we go, I don't think he gets the thumbs up for this if I've read correctly, there is still uncertainty over the central bank's policy direction. I've prejudged him. Let's listen in.
I think inflation continues to be a little bit sticky. I think there's a possibility of a rate cut or two this year. But I could also see if the data, doesn't prove, to move in a direction to support that we could stay where we are. And so I think the Fed's been very clear. They're watching the data, and until they see, inflation come in just a little bit more, they're going to be cautious on whether or not they move rate cuts through the system.
Nah.
He gets a thumbs up for his share price, hey?
He gets a thumbs up for share price. He gets a thumbs somewhere like that for whether he said anything new about the central bank. Yeah, they're in a good place. 1 to 2 cuts probably. Could say they're all data driven. Which is similar to data.
But we are, right? We are all data-driven, aren't we? And let's push on. We've got to look at some deal-making. Banco Sabadell has rejected a merger proposal from rival BBVA, which would have valued the Spanish lender at 12 billion euros. Sabadell says the offer significantly undervalued its potential and growth prospects, and that the recent decline in BBVA shares raised uncertainty around the value of the deal. BBVA said it regrets the Sabadell board rejecting what it described as an attractive offer. And to the data watching and to interest rates, I mean, there is a story here, concerns for some of the big banks that what they've seen has been a tailwind in the form of higher NIMs, higher income through the net interest margin side. That will fade as soon as the ECB joins up the central banks and starts cutting. So some deal making here, creating larger banks, seen as a preemptive move, trying to get ahead of that curve.
No. Really?
Absolutely.
I saw that in the copy. You honestly think, no, you don't think that. The rationale over a 10 to 20 year period, over a long term for these mergers matter over beyond cycles. You think the next interest rate move matters whether this deal or the rationale for the thinking of whether these deals happen or not. The next couple of interest, I don't believe that for 1 minute. I think they look way beyond the cycle.
Having just come out of a very difficult time frame for the last 10 years of pretty much no decent NIMs, thanks to 0 to negative interest rates in Europe.
Entirely.
I think they've now had the ability to build a slight war chest so they can embark upon some M&A. I think absolutely they're trying to seize the moment.
Look, I appreciate in Europe as well, we are challenged challenged. We have been challenged by zero interest or negative interest rates as well. But actually, there have been decent NIMs, net interest margins, at a whole host of European banks throughout the cycle as well. They haven't not made money when we had zero interest rates. They were getting free money from the
torturous. Every earnings season has been torture.
They have been free money from the central banks because they've had basically free money thrown at them, and they have been able to issue loans at a significant premium. NIMs of 2 to 3 to even higher percent have been in existence throughout the entire time. I appreciate it's easier when the central bank has higher rates, but they have had decent NIMs, some of them.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com or join us again on the show with me, Steve Sedgwick, and Karen Cho, weekdays on CNBC.